You're listening to the Perth Property Show, Australia's only weekly property podcast by West Australian experts for West Australian listeners. Catch your latest episode every Monday at 7 a.m.
Good morning, everyone. Welcome to the Perth Property Show. My name's Trent Fleskens, your host as always, and with the continual onslaught of the ATO trying to pull back our tax deductions when it comes to property and conversations around capital gains tax, negative gearing, things like superannuation, all those questions that are starting to pop up in the Labor government's very safe period of tenure at the moment, where they might be able to have a conversation about making our tax system more efficient in their eyes. I thought it'd be worthwhile getting our favourite accountant, Carlo Bordi from Bordi and Associates, back in the studio to have a conversation about those 101 questions: depreciation, CGT, deductible expenses, negative gearing. Do these things actually matter to us? What can we claim, what can't we, especially for those younger, newer listeners, or all those listeners who have been going on a journey with us and it's finally starting to be relevant to them. Carlo, thanks for coming in, mate.
Yeah, you're welcome. Thanks for inviting me again, Trent.
Carlo, the questions we want to ask today are really back to those basics, the 101s, the stuff that people would talk about around the dinner table and talk about how their accountant got this deduction, but they couldn't really explain how. And then the friend across has gone, oh, I'm doing this, and look, I'm looking into that. Some of it seems quite interesting to me as to what, even listening to my mates, they think is deductible and what's not, and how a negative gearing may or may not affect them. So let's go through in real basic detail today. We've got the top 10 questions we think are most relevant from our listenership with regards to what you might ask your accountant for your investment property.
Yeah, and look, this is a common scenario that does exist with most clients. At the end of the day, people just want to know, what's my bottom line?
Exactly right. What can I get back?
Yeah.
So let's start with really the easiest question. What property expenses can I claim as a tax deduction? And then we'll talk about what can't we. So off the top of your head, loan interest?
Yes.
Any caveats to that?
Look, there are, but at the end of the day, if the loan was solely taken out for the purpose of buying the property, the interest should be fully deductible.
As long as it's being rented?
Good question. In relation to second-hand residential, the answer is normally always yes. However, if you've purchased a property and buying land and then building the property on there, and then for some reason have got it vacant for a number of weeks, and they say 6 or 8 weeks because you're painting the inside and the outside, then the Commission says no, under the new land rules, you can't then claim the interest as a deduction, and it gets added to the cost base for the capital gains.
Okay, so it is eventually, let's call it deductible, or you're getting that hit at the end, but not in your annual return straight up.
You do, it's quarantined, but keep in mind that with regards to capital gains, currently the legislation says there's a 50% discount on the profit, which ultimately means that
50% deductibility.
That's exactly right.
All right, got you. So we do want to try and make it look like at least that we're trying to rent this property out.
Yeah, you're trying to maximise that interest deduction in the period that you've incurred the cost, yeah.
That's a really good point, and most people wouldn't have got that. What about PM fees, property management fees?
Yeah, anything that relates to the property which is not adding value to the property is pretty much deductible.
So that would be rates, things
council,
like that as well?
Land tax, repairs, agents' fees, bank charges, all your normal stuff that happens, our water rates that apply to the property, council rates, all those things that, you pay them once and it's gone and you get no other benefit other than to pay the bill, are normally deductible.
What about depreciation? Now, we've spoken in the past about the benefits of it, but also the veiled benefits in that they're not as good as it seems. What we know is that the ATO over the years has tightened up on depreciation. You used to be able to claim depreciation on anything in terms of new property, second-hand property. How does it work, and what is it relevant to in 2025?
Back in 2017, the ATO introduced a new legislation, and it relates to what they call second-hand property. So if you've bought a second-hand house, or you lived in the house yourself and then you make it available for rent, even if you bought that house brand new yourself, you cannot claim the depreciation on the assets. Now, depreciation is on stuff like carpets and curtains and ovens and hot water systems and light fittings and stuff like that. However, you can still claim what's called a special building write-off, which is like a depreciation on the actual building, the bricks and the mortar and the roof and the tiles and the driveway. And that can all be done through a licensed valuer or surveyor. It can't be done by a real estate agent, so it's got to be a qualified person to do that.
Accountant can't do it?
Nope. It's got to be done by a qualified surveyor that's got the accreditation to do such a report.
And we can get those reports for $500 online, but we can also get them for $5,000 by an individual who comes out and does it. Have you seen much difference in the quality over the years and what you can and can't deduct? Does it matter to the ATO?
Look, at the end of the day, the cost to get these reports, they probably vary between $450 to maybe $800 if they're residential and they're in close proximity to the CPD. If you're up in Broome or something, then probably the reports are going to cost you a couple of grand. But the expense on that, fully deductible when you incur it, and the added advantage is that you then get a deduction every year without not physically spending money. So if they work out that the building, and I'll make this up, is worth $100,000, you can then claim 2.5% on that, which is $2,500, effectively for the next 40 years.
As you depreciate it down to zero.
Correct.
And then just pulling it back there, when it comes to all the fittings in the house, you can only claim that if you've owned it as an investment property from brand new.
Yeah, so if you had a builder build it and no one else has ever occupied the property and you're the first person that's ever utilised it as residential, then yes, which is pretty restrictive.
Got you. But at the end of the day, as you said, even if we can't claim depreciation, what we do know is that we can take it off the capital value at the end when we're selling it and hopefully making a capital gain. But that would be a 50% discount on that too, wouldn't it?
Yep, absolutely. So, and people sometimes say to me, what's the use of claiming this if I've got to give it back?
Yeah.
And look, the reality of it is, with a couple of assumptions, assuming that you're in the same tax bracket when you be claiming the deduction and when you sell the property, you're getting half of it back. So there's still that advantage, and we strongly recommend you do it.
Got you. Let's move on to the next question. How does negative gearing work? In 2025, is it still beneficial? Now, this is a pretty hot political topic, and it has been for years. And I think it is because a lot of people don't understand how negative gearing works. I think people just think that if my expenses were $20,000 this year, I get $20,000 back. That is a total misunderstanding of deductibility, let alone negative gearing in the first place.
And to keep it simple, negative gearing really represents, what have I lost on this house? In other words, this is an example where you've got a property and you are renting it out for $45,000 a year, but your expenses come to $65,000. So therefore, technically, you're losing $20,000 a year. That $20,000 is what technically goes in your tax return, and that's what you're claiming as a deduction. And what you get back of that is dependent on what your tax bracket is. So if you're in the 47% tax bracket, you get 47% back of that $20,000.
Yeah, so if you were making $200,000 a year as an income, being, let's call it an accountant, and then you've taken $20,000 off because of your property loss, let's call it that year, then you're in the 47% tax bracket. You then essentially should be reducing your income by that $20,000, and therefore your tax would reduce by a 47% of that, right?
Yep, basically correct, yes.
You're not getting $20,000 back, you're getting your tax rate on the $20,000.
And look, if a person's in a situation where they're earning no other income, then they get nothing back.
Because they're not paying.
That's exactly. So it's all depending on your bracket. So if you're earning up to 45, then you're only getting a bracket of 16, 17%. If you're earning over 190,000, then you're in the 47% tax bracket, and so on, and there's a sliding scale between those two figures.
And I guess in 2025 it becomes even less relevant because there's a lot of people these days, as rents have increased by 80% in the last 5 years, who are not negatively geared. They aren't losing money within the tax year. They're actually making money because the rent might be $80,000 and the expenses might be $65,000, and therefore they've actually made a $15,000, all things else being equal, profit that year. And so actually they'll be paying tax on that $15,000, won't they?
And that's where, if you get the report done in relation to the special building write-off entitlement, you get a deduction for the cost of construction, which reduces that profit as well. But ultimately, yes, if that combined with all other expenses is still showing that you're making money, you're taxed at your marginal rate.
And therefore, negative gearing is irrelevant to you.
It doesn't apply because you're not, after all your allowable deductions and claiming your non-expense items like depreciation and special building write-off, if you're not showing a loss, then because negative gearing is basically, I'm showing a loss.
It's a tax safety net, really, isn't it?
It's a tax concession, possibly the way to look at it. And look, and there is one other little variable that happens here, and that's if you start renting out properties to your family members or friends, and if you're not charging them market rates, you can't show negative gearing. You can't show a loss. the best you're going to do is break even on it, and the expenses that you can't claim will also affect your capital gains calculation at the end. So you don't lose it, but still not as good.
Okay, so I guess the message out of this is, yes, for those people who are making a loss at the moment between their rent and their expenses, negative gearing does benefit you by your tax rate of the loss. If your tax rate's 30% and your loss was 10 grand, you would have got a $3,000 benefit out of negative gearing legislation. But for the rest of us who are in a position where our rent is more than our expenses, it's relevant to a lot of people these days. And if it does get to a point where negative gearing is removed by a Labor government, because I don't assume it would be a Liberal government, then it's not the end of the world. It really isn't impacting a lot of people these days. Let's move on to the next question. What are the capital gains tax implications when I sell an investment property? Now, I guess, Carlo, there are a few scenarios here with regards to how long you've held the property and what your expenses are along the way. But when we think politically, when they talk about reducing the capital gains tax discounts, that's where it starts to come in, isn't it? Let's first define a capital gain.
Basically, a capital gain is in layman's terms, how much did you pay for the property compared to how much you've received for the property at the end after allowing for all the costs associated with selling that property. That bottom figure then, if you've kept the property for more than 12 months, entitles you to a 50% discount, and only that 50% value is put in your tax return. So in other words, if you bought the property for $400,000 and after all expenses you sell it for $600,000, you're making a $200,000 gain. You only put in your tax return half of that, which is $100,000 in your tax return.
Got you. Okay. The capital gain would have been $200,000. The discount legislation allows us to only place $100,000 on top of our $200,000 accountant income for the year, and therefore we're paying 47 cents on the dollar on $100,000 more than our salary. Does that make sense?
It does.
So when we're thinking about the 50% discount, that actually is quite applicable to a lot of people, especially those who have owned property for the last few years, because most people would have made a capital gain if they were selling. I'm not sure whether this legislation, if they ever reduced it to 30 or 20%, would have grandfathering rules where if you already owned the property, then you still get the 50% discount, but anything from now on that you purchase and consequently sell would only have a 30 or 20% discount attached to it. Maybe that might be the legislation that eventually gets pushed through Parliament, if it ever does. But what we do know is that it does have significant implications on essentially the amount of money someone takes home after they've made a capital gain.
You're right, but I'd like to think, and historically what happens with most of this legislation is it's as of a set date. So in other words, if you buy a property as of tomorrow, the new laws are that if the discount is going to be reduced from 50% down to 25%, it normally applies to those properties that are acquired from tomorrow onwards. Historically, they normally allow the old legislations, or there's like a grandfathering legislation that says you've got 2 years to sell this. If you sell it in 2 years, you still get a discount. So they're not going to just cut you off at the knees with an old existing property that you maybe hypothetically allowed for only paying 50% when you retire and that's going to be your nest egg. There is like a shading in period normally that does apply with most of this legislation.
It'd be interesting to see how that does affect a property market nationally, to be honest, because I think what it would do is, whether it impacts you or not, the feeling would have people, I think, selling more often, having more of an impetus to sell than they otherwise would have if legislation like this did come in. In a similar way that if negative gearing changes were to come in as well, it changes sentiment, I think. And it may be something that the market needs, to be honest. More people selling right now is something that we could do with a little bit to assist with mobility in this market.
Oh, look, I agree with you. I think ultimately, if these measures were introduced, the average person would think, oh, I'm not going to miss out on this discount. I'm going to make sure I sell my property within that time frame that I'm given. And you could see a substantial number of properties hitting the market. And as you supply and demand, the more properties on the market, the more likely prices are going to come down because there's more competition in the market.
Next question, should I buy the investment property in my personal name, a trust, or a company? Now, we have gone into that in detail a couple of hundred episodes ago for people listening. But to keep it simple, there are really three options there, aren't there? We can buy it in my name, Trent Fleskens. I can buy it in Trent Fleskens as trustee for the Fleskens Family Trust, or I can buy it in Fleskens Incorporated, Pty Ltd. Those are my three options, aren't they?
They are your available options, but one of those three options we would normally say discard it completely. If you buy a property through a company structure, the consequence is that the company will not get the 50% discount when the property is sold. So we normally say to people, avoid that scenario.
Would you suggest the same answer if I was a property developer?
If you are developing to the sake of reselling, then you don't get the entitlement to get a capital gain discount. It's simply all taxable. Yeah, then having in a company structure is a far better vehicle because you're paying tax at 25% instead of your marginal rate. You can then quarantine the other 75% and do another project and roll it into from one project to the other.
Let's probably pick, if we can, the correct entity or the most likely beneficial entity for the intent. So a company structure would be best used for someone who's looking to develop property and create new property out of that, right?
Yes, correct.
A personal name. I want to buy it in my personal name, Trent Fleskens. What would that be best for?
And look, ultimately, it's great to have a crystal ball because you have to consider when you sell it whose name is it in and what tax bracket they're in. But ultimately, if you've got a property that's showing losses or negatively geared, this goes back to that legislation and a termination, it'd be better to be in the person who's in a higher tax bracket. They get the maximum deduction on it. And look, and then when you sell it, your circumstances could change. You could then be retiring, you may not be working. So let's work on the positive, let's maximise your deduction, put in the person's name that's earning the most.
I guess the personal name has the best giveaways by the tax office in this day and age in terms of the capital gains discount, in terms of the negative gearing. So as long as you're involved in a fairly simple property investment without changing the nature of the property, you're going to get the best bang for your buck out of a personal name, with also probably the lowest accounting costs as well out of the
look, as soon as you introduce structures, then it gets a lot more complicated. And look, don't get me wrong, trusts also do have their place. If you've got a property which is not costing you anything, in other words, it's either positively geared, so it's actually making you money, or equally geared, but not making very small losses, because with the trust, the losses don't get allocated to anyone. They get quarantined until the property either starts making rental profits or you make a capital gain when you sell it. So that's when it gets applied.
So a trust might be a good opportunity for someone who's going to buy a property they know will be positively geared from day one, or if maybe they're in a situation where there's multiple people in the family who may benefit from those returns in the future.
The advantage of the trust is that you don't have to really worry about who's going to be paying the tax on it until you physically sell it. And then most family trusts have got a pool that you can then dip into and say, I'm going to allocate this profit to my wife or to my children.
So it allows you to be flexible with your returns, your dividends, let's call it, at the end of the day on that, rather than having 4 people buy it in equal shares and that being very rigid over the time.
Yeah, there's great flexibility with the trust in allocating those profits, dependent on, as long as you don't distribute to minors, people under the age of 18.
What we also know is it's a little bit harder to get finance for trusts and companies. You have to put more of your cash towards the initial purchase as well, so your leveraging isn't as good as a personal name too. And as you said, the accounting costs in trusts and companies over the years are more expensive than in your personal name. Now, we should speak to an accountant about your personal situation when you're making these decisions, but overall, those are the way that you would match up the 3 entities with the 3 situations.
Yep, most definitely.
Let's go to the next question. What's the difference between repairs and improvements for tax purposes? Now, let's maybe talk about a specific trade, if you can, and give that as an example.
This topic is such a hot topic that it's almost ridiculous, and sometimes logic doesn't prevail here. The basic definition is if you are improving something or if you're changing the entire unit and it can function in its own capacity, it's then normally an improvement. I'll give you an example. So if you were to change a hot water system on a house, that pretty much functions in its own capacity. Okay, there's pipes there, but a hot water system, an oven, a stove, they all function in their own capacity and they are subject to depreciation. And if the old one breaks and you buy a new one, you've got to depreciate the new one.
Okay, so if you replace something, that's an improvement. If you fix something, it's a repair.
Now, fixing is also, what's fixing? Well, if part of your fence blows down and you change it, that section, that's a repair. But if you were to say, oh, look, the whole fence looks a bit tatty, some of it's gone down, I'm going to rip it all out, I'm going to put a brand new fence, it'll look a lot nicer. That's defined as an improvement.
What about painting? Now, painting, some would say, is a repair. It's pretty hard, to be honest, for the aid to, and I don't think they'd ever come out and check that when we're thinking about these things. But by the letter of the law, my kid goes and scratches up the walls having a bit of fun. I get a painter in. Painter comes in and repaints. Normally that's a repair, but it's also improved the wall.
There's some latitude there. The ATO basically says if the damage is caused by the tenant and you are simply bringing it back to the same state and you are painting the whole house inside and out, it's normally defined as a deductible expense unless you incur the cost straight after you buy a property. So if you buy a property and you go, oh, it's looking tatty, before I start renting it, I'm going to paint it all, then it's not a repair.
Got you. Okay. And what about landscaping?
That's an interesting one.
Because I've seen some landscaping where you think the plants were dead, we put new ones in, or we've got new mulch in, the old mulch didn't look great, we put new mulch in, and then others where you say, that's now improved it, hasn't it? All landscaping generally improves the situation.
The way the ATO have tackled this is the initial costs you incur in doing your gardens, right, lawns, plants, mulch, is normally not deductible. It's all forms part of your cost base of your property for capital gains purposes. But then, these plants have died, I replaced these plants. Oh, this section of lawn's died, I've replaced the lawn. Oh, that tree's gone a bit too big, I've knocked it down and I've put some extra shrubs there. They are all normally defined as deductible because you're simply replacing. But if you had a section of garden that was all lawn and then you spent a substantial amount in putting new gardens and new reticulation in there, then it could be viewed in a different light. But normally...
I mean, surely this is not stuff the ATO is pulling us up on either way.
It's not normally, because normally they're not big ticket items. Most people, when they replace some plants, they might spend $500-600 on plants. Get them, I don't know, a handful of plants and they replace those plants. It's fine.
And I guess we have to look at it through that prism, the ATO thinking, is it worth our time to investigate this as well?
And look, the ATO main focuses on rental properties normally target two main areas. One is interest and two is repairs. It's a matter of defining those correctly and keeping it under the radar from the ATO.
GST. I've still heard a lot of people say, hey, I wouldn't want to buy it in a company because then I'll pay GST. If I'm in a personal name and I do a subdivision, I won't have to pay GST. There's some misunderstandings in that, but just generally, the question here is, do I need to remit GST on my rental income or on the sale of my investment property? There's a number of situations there. Obviously, if it's in a company, we've got different outcomes to if it's in a personal name. But I guess it comes also down to, is this a profit-making scheme?
Look, at the end of the day, most of the people out there will be having rental properties which are residential rental properties. And under normal circumstances, most people would not have enough property to be defined to be in business. So the person who's got 5 or 6 or 10 rental properties, no GST applies in relation to the rent. Okay, you're not in business of renting properties, you're simply investment. On the sale, also the same would apply. No GST would apply to the sale unless you're in a situation where you have built a new residential property and then you sell it within 5 years of construction. Then GST will apply to that sale, even though it's a rental property.
So that's the supply of new residential property.
Yeah, because the ATO actually say that GST applies to new residential property, and that definition extends over the 5-year period.
And that includes land as well, doesn't it?
It's virtually the whole package.
So if you do a house behind a house or you split your backyard off, you've created new supply of property, land and or house, and therefore GST will apply. And you should really have great accounting advice along that way so you don't get hit with the full 10%.
Look, unfortunately, it's a hidden trap. This building of new properties, if you sell them within the 5 years and it's been an investment property, then you can get caught out badly.
Let's move on to the next question. What can't I deduct that most people think they can?
2017, the ATO closed the gates on travel. Basically, any costs associated with travel, whether you're flying interstate or up north and you're inspecting your property, you're doing repairs to your property, your flights, your meals, your accommodation, all those costs are all sunk. It doesn't get added to your cost base for capital gains. It's not deductible. It's basically you've thrown that money away.
Yeah, and I remember people back in the day having a property in Melbourne or Brisbane and saying, hey, this is all deductible, my holiday, to go check out my house.
Some people, look, unfortunately, it's the minority that have wrecked it for the majority. A lot of people do it properly, but the ATO have just said it's too hard for us to police it. Even driving to your real estate agent that's managing your property is not deductible.
I guess this is one of those ones where even though it is an expense for a lot of people and it is something that is realistically a cost for doing business in that sense, there's not much we can do about it.
No, it's all out.
Is there any problem with owning multiple investment properties for tax? I guess the first one might be the accumulation of land tax. Some people suggest, what if I went and bought a different property with a different company every time? Obviously, it's expensive to open a new company and do the accounting on a quarterly or annual basis with these businesses. It's certainly far more expensive than owning 5 or 6 properties in a personal name. But do you ever see a situation where it actually is beneficial simply because you're resetting that land value base every time you use a new entity rather than accumulating it all within the same person's ownership?
I'll just clarify something. You can buy a property under a company structure, but you've got to make sure that the company is the trustee for the family trust. Because again, if you buy it solely in the name of the company and there's no trust behind it, then there's no capital gains discounting of the 50%. So a lot of clients, what they're doing is they're using a company as trustee for the family trust, and technically, for tax purposes, it's shown that the trust owns the property. In WA, a trust can't be seen to be owning property. It has to be either an individual or a company. But the loophole there exists when you do your offer and acceptance. You say ABC Proprietary Limited as trustee for my family trust, and then the ATO accept that as being owned by the trust and allows you to get the discounts when you sell it.
Okay, so what you're suggesting is there may be an opportunity for reducing your land tax bill lower than the accumulated cost of accounting for all these different companies, as long as you also consider not losing the 50% discount by being the trustee, a corporate trustee of a family trust that still eventually will benefit from those discounts. Otherwise, you're robbing Peter to pay Paul.
You do. And ultimately, you've got to really consider you'd have to have multiple properties. I've got one client that's got 64 properties in his portfolio.
The land tax would be pretty big.
And he now has diversified by using trust in the way we've just described it.
But you can't go backwards, can you? You can't just change. Stamp duty starts to get involved.
If you think, okay, I'm going to transfer this out of my name and put it into a trust, then you've got a deemed sale, you've got capital gains associated with that, you've got stamp duty and buying on the other side, so you get slapped on both cheeks.
What it means is it's so important to get that right from the start, and therefore getting the right advice from the start about what your circumstances are now, but also what they may be in the future. If you're planning to own 40 properties at some time in the future, you probably will start off with the increased early days cost of owning in separate companies to know that one day you're avoiding $100,000 a year in land tax.
Yeah, look, and it's great to have that crystal ball. And I think most taxpayers out there don't acquire that many properties, so it's the minority would apply this. But for the majority, I think, look, the individual names or possibly a trust is the way to go forward. And it's just a matter of understanding how both work and seeing which one best fits you at that point in time and obviously in the future.
Carlo, last one. What's my cut-off date for getting my tax done without being penalised by the ATO?
If you're doing it yourself, 31st of October is your due date. If you're using a tax agent and you haven't historically been late with your tax returns, your lodgement date can be as late as the 15th of May 2026.
Well, that's all right. Don't mind that.
Yeah, but you've got to make sure you go to see your accountant before the 31st of October so they can put you on their listing, so that for the concession doesn't apply to you, the taxpayer, the concession applies to the tax agent to be able to lodge your return later.
To be honest, I guess that really depends on which way you're planning to be. If you think you're going to have a refund, you'd get it in on the 1st of July, wouldn't you? If you think you're going to be paying some money, you'd probably wait as long as possible.
And keep in mind that you can always prepare your return and not lodge it until the death knock. So yeah, you can know where you stand, you can allow for it, and then lodge it on the 15th of May, and then you've got about 3 weeks after that, you've got to pay your tax bill.
Love it. Carlo Bordi, thank you so much for coming in and clearing up a lot of these simple but complex questions for our listeners.
Pleasure. Thanks for inviting me.
Thank you for listening to another episode of the Perth Property Show. If you've only just joined the conversation, you can catch up by heading over to our website, perthpropertyshow.com.au, subscribing to the podcast, or joining our Facebook page. Don't forget to tune in next Monday at 7 a.m. for more expert insights, local analysis, and suburb spotlights. Happy hunting!